Imagine you want to buy something today, but you do not actually want to take it home until sometime in the future. This is a simple idea behind a forward contract. It is an agreement made directly between two people to buy or sell an asset on a specific date in the future using terms that are decided right now. Think of it as a bridge connecting a decision you make today to an action you will take later. We see these agreements used everywhere, from physical goods like oil and wheat to financial items like foreign currencies or company shares. To see how this works, let us first look at how we usually buy things in the regular market. Imagine it is May 11th, 2024 and you want to buy 10 grams of gold. The current market price on this day is 62,130 rupees. You give the goldsmith the cash and he gives you the gold immediately. In the professional world, we call this a cash market transaction or a spot transaction because the deal happens right on the spot. But what if you do not need that gold today? Perhaps you only need it 1 month from now. You could wait until next month to buy it, but you might worry that the price will go up. Instead, you and the goldsmith agree today on a locked-in price of 62,337 rupees for 10 grams of gold to be delivered 1 month later. Today, no money changes hands and no gold is moved. You have simply created a customized solution to lock in your future costs. In the world of finance, we use specific names for these roles. Since you are the one agreeing to buy the gold later, we say you have bought a forward contract or that you are long forward. On the other side of the deal, the goldsmith who is agreeing to sell you the gold later has sold a forward contract or is short forward. It is a simple way to describe who is the buyer and who is the seller in the future. It is important to understand that this is not just a casual promise. 1 month later, when the agreed date arrives, you are legally required to pay 62,337 rupees and take your 10 grams of gold. This is an obligation. Even if the market price of gold has changed drastically, both you and the goldsmith are obliged to go through with the deal at the price you locked in. This ensures that both parties know exactly what to expect. There are a few essential features that make these contracts work. First, it is a bilateral agreement, which just means it is a direct deal between two parties. Every important detail is decided on day one. This includes the exact price, the quantity of the asset, the specific quality of what you are buying, and the delivery terms, such as where and how the exchange will happen. Because these deals happen directly between people or companies rather than through a public stock exchange, we call them over-the-counter transactions. This allows for total customization. If both you and the other party agree, you can change any of the terms to fit your specific needs. This flexibility is why big corporations, professional traders, and investing institutions use these contracts to meet their unique requirements. So, why go through all this trouble? The primary objective is to fix the price and avoid price risk. By locking in a number today, you are protected from the uncertainty of what might happen in the future. It acts like a shield against price fluctuations, giving you the assurance of exactly how much you will pay or receive for an asset. Let us see how this plays out in a real-life scenario. Imagine that after 1 month, the market price of gold has risen to 62,700 rupees. Because you locked in your contract price, you only pay 62,337 rupees. This is a favorable situation for you because you are buying the gold for less than the current market rate. If you were to sell it immediately at the market price, you would make a net profit of 363 rupees for every 10 grams. However, the market can also move against you. If the market price falls to 62,100 rupees, the contract becomes unfavorable. Even though you could buy gold cheaper in the open market, you are still legally obliged to pay the higher contract price of 62,337 rupees. In this case, you would face a loss of 237 rupees per 10 grams. This is the fundamental trade-off of a forward contract. You give up the chance of a better price to gain the security of a guaranteed one.